For Europe to remain competitive, finance must take centre stage. As a leading financial centre in the EU, Luxembourg offers a blueprint for unlocking the potential of Europe's capital markets. Serving as a bridge between international capital and European opportunity, Luxembourg facilitates both inward investment and global reach for European investors. Its open and efficient financial ecosystem removes barriers to capital flows, enabling companies to scale and innovate. As a leader in cross-border fund distribution and private assets, supported by advanced capital market infrastructure, Luxembourg contributes to a stronger European financial future while extending its global influence. A robust financial system means broader opportunities for all.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Ladies and gentlemen, good morning. I am Benoit Theunissen, Policy and Regulatory Advisors at Luxembourg for Finance. It is my pleasure to welcome you this morning to this event dedicated to the Savings and Investment Union. Thank you for joining us today for what we hope will be a timely and forward-looking discussion on one of the most important projects for Europe's economic future. The Savings and Investment Union sits at the intersection of competitiveness, growth, and strategic autonomy. And it raises a fundamental question: how Europe can better mobilize its savings to finance its long-term priorities. The program of this morning opens with a keynote address setting the strategic context for the Savings and Investment Union. The keynote, entitled "1 year after the Draghi report, the case for the Savings and Investment Union." It will be delivered by Anne.George Kuzuhara, Senior Counsellor at the Luxembourg Ministry of Finance. It will then be followed by 3 focused discussions exploring the key building blocks of the Savings and Investment Union. We will begin with the pension challenge, looking at how Europe can strengthen long-term savings and retirement provision. This will be discussed in a fireside chat with Corinne Lamesch, Deputy CEO and General Counsel at the Association of the Luxembourg Fund Industry, ALFI. She will be interviewed by Silke partner at Linklaters. We will then turn to the securitization thematic, a key mechanism for connecting savings to the real economy. This discussion will be led by Frank Mausen, partner at Shearman and chairman of the Luxembourg Capital Market Association, Lux CMA. He will be with Dr. Michael Genser, head of Solvency Management at Deutsche Bank, and with Paula Redondo Pereira, head of Government Relations and Regulatory Strategy at the Luxembourg Stock Exchange. Finally, we will look at the role of private capital in financing Europe's strategic industries. It will be in a fireside chat with Mathieu Jourde, Equity Portfolio Manager at BNP Paribas Asset Management, who will be interviewed by Jérôme Wigny, partner at Elvinger Prussen. With that overview, let me now invite Anne.George Kuzuhara to take the floor for the opening keynote.
Thank you, Benoit. Ladies and gentlemen, it's a great pleasure to be with you today. 1.5 years after the Draghi report, the overall diagnosis still holds. Europe's competitiveness remains under pressure. The sense of urgency has intensified in the current geopolitical context. We all agree on the objectives: to make Europe's financial markets less fragmented, more efficient, and capable of supporting Europe's strategic priorities, such as defense, environmental, and digital transition. So where are the barriers holding us back? This is not about a lack of capital. European households have close to 15 trillion euros in bank accounts and cash deposits. Nor is it about a lack of ideas. Europe is rich in entrepreneurs and startups ready to innovate and grow in Europe if the conditions are right. The challenge is in the execution. Reconnecting through efficient capital markets, capital supply and capital needs. Since the Draghi report, Europe has begun to take action. The Commission is gradually implementing its March 2025 strategy for the Savings and Investments Union. Competitiveness is at the top of the political agenda. Simplification is now recognized as a necessity. The Commission's ambitious omnibus proposals on simplification go in the right direction. These proposals are a good start, not the finish line. Today, Europe operates under a simple reality. Its regulatory framework has become too complex. The sheer volume of the European rulebook is mind-boggling. Estimates point to over 70 directives and regulations, more than 1,500 technical standards, and nearly 800 guidelines and recommendations, not to mention countless reports, surveys, and reviews of existing legislation. Since the 2008-2009 financial crisis, there has been no genuine period of regulatory consolidation. Legislation has been a constant motion, leaving markets in a state of continuous adjustment. Europe must pursue a simplification agenda while preserving financial stability and investor protection. Since the Draghi report, other progress has been made. The revision of the securitization framework is on its way. Securitization plays a key role in freeing up bank balance sheets. It broadens funding options for companies. It supports households, SMEs, and strategic sectors. Yet, in Europe, securitization has underperformed for years. We must unlock its full potential. The Commission has also followed up with recommendations on pensions, savings, and investment accounts, providing guidance to member states to link citizen savings to long-term investment. But we cannot be complacent. Much remains to be done, urgently. Europe remains fragmented. National barriers do exist. As a country deeply connected to Europe and the rest of the world, Luxembourg has every interest in seeing the Savings and Investment Union succeed. But we need to go back to the basics. The European passport should be fully operational. In reality, it is not. National add-ons and gold plating persist, often in the name of consumer protection, sometimes for more protectionist reasons. Last December, the European Commission presented its market integration and supervision package. The proposal rests on 4 elements. First, removing certain barriers to cross-border investment and limiting gold plating. Second, transferring direct supervisory powers to ESMA for certain significant market infrastructure and for crypto asset service providers. Third, substantially expanding ESMA's power, notably where supervision remains at national level. And fourth, reshaping ESMA's governance to concentrate supervisory authority. The package does include some useful elements on removing regulatory barriers and gold plating. Unfortunately, it focuses to a large extent on the centralization of supervision. And this is not the solution. Fragmentation does not come from supervisors sitting in different capitals. It comes mainly from gold plating, from national divergences in insolvency, taxation, and consumer protection law. Adding a new supervisory layer will not fix this. Centralizing supervision would increase cost, add administrative complexity, and weaken local financial ecosystems. Our view on centralization is not dogmatic. It's not about protecting vested interests. It's just a pragmatic assessment of the proposal and the Commission's impact assessment. And let me give you a few concrete examples. ESMA currently lacks both the supervisory expertise and the resources to carry on the new supervisory tasks. Supervisory functions will need to be scaled up at European level, relying heavily on national regulators' expertise and resources. A move towards centralized supervision can only lead to additional supervisory costs for regulated entities. Administrative complexity is also lying ahead. Regulated entities such as investment firms very active in crypto assets would report to national regulators for their core activities and to ESMA for crypto asset services, at odds with the simplification agenda. On the preservation of much needed local ecosystems, centralized supervision risks disadvantaging SMEs and financial centers built on proximity and expertise of national regulators. Regulators who understand the local business culture and speak the same language as the entities they supervise, literally and figuratively. The single supervisory mechanism is often cited as a model for centralization. There is a flaw in this comparison. The SSM was designed to address systemic banking risk after the financial crisis. Its objective was financial stability, not competitiveness. Even under the SSM, fragmentation persists in banking, and European banks still lag behind their global competitors. Centralized supervision has not proven to be a guarantee of competitiveness or a solution to fragmentation. So what should be done instead? The priority should not be to create a new layer of regulation, but to streamline the existing framework. Europe already has a rich set of investment vehicles, from UCITS and AIFs, such as LTIFs, securitization, PEPs, IORPs. We do not need to invent new ones, just enhance them where necessary. Rather than endless institutional debates on centralized supervision, the priority should be to ensure these products can be offered seamlessly across Europe. That means tracking and eliminating gold plating in national legislations, and improving convergence of supervisory practices. Because market participants are entitled to receive the same answers to the same questions from regulators across Europe. The convergence tools already exist in the European Supervisory Authorities funding regulation. Those tools did not fail. They have not been used to the fullest extent. Priorities have been elsewhere on drafting technical standards and other secondary legislation. Now the focus should shift from legislative production to supervisory convergence. Efforts should go primarily to alignment and consistency of supervisory practices. To be successful in delivering on the Savings and Investment Union, we must also foster a strong and widespread investment and risk culture across all types of investors. That can only be done by raising the financial literacy level in Europe. The Commission has recently set out a financial literacy strategy highlighting the remaining gaps. Not all initiatives need to start at EU level. Member States also have a role to play through national initiatives to achieve the objectives of the Savings and Investment Union. Luxembourg intends to play its part by delivering concrete and immediate solutions. For example, in capital markets, we are focusing on new solutions, including sustainable and defense-related financing, aligned with Europe's strategic priorities. Luxembourg has played a leading role alongside other member states in the Competitiveness Lab and the Finance Europe label to mobilize private savings. In parallel, we are strengthening our fund ecosystem, including in active ETFs, where assets are approaching €500 billion, and consolidating our position as a leading hub for digital assets. As a cross-border financial center, Luxembourg is adequately equipped to channel and unlock the investment Europe needs. This is the right mindset to approach the Savings and Investment Union. Focused, pragmatic, and oriented towards an immediate result. Luxembourg will continue to deliver concrete solutions, working closely with its European partners and with the industry towards achieving the Savings and Investment Union. I wish you a very productive discussion today. I give now the floor to Silke Bernard, partner at Linklaters, for the next fireside chat on the pension challenge. Thank you.
Thank you very much, Anne.George, and welcome, ladies and gentlemen. We will now be looking into the pension challenge. And I have the pleasure of introducing Corinne Lamesch, the Deputy CEO of ALFI. The SIU, based on the Draghi and Letter report, as we have just heard, point at the European pension system and the lacking retirement provisions as being one of the weaknesses of the European economy. Corinne, pension solutions have been for long a priority for ALFI, both as an opportunity for the financial industry and also as a threat if we don't get it right in Europe and in Luxembourg. ALFI has recently worked together with McGill on a study that produced some truly interesting findings. Can you share with our audience some insights into the study?
Yes, thank you, Silke, and good morning, everyone. So the title of our panel is indeed the pension challenge. So let me set the scene of how big this challenge is. And that is also what came out of our study. So it is a fact that Europe's economy has fallen behind the US and China in productivity, capital formation, and technical and business innovation. We also know that Europeans have higher household savings than Americans, but their household net financial wealth is 5 times less than that of the Americans. This is due because Europeans do not invest. Indeed, we have around 14 trillion savings which are held in cash deposits instead of being channeled towards productive investment in Europe. It is also a fact that many EU member states still largely rely on the first pillar pay-as-you-go systems. And we know that these systems are doomed due to the evolution of demographics and also due to the high costs they are generating for the governance. It's a big strain on budgets. So what we did to look further into this productive gap, as I mentioned, we commissioned a study with McGill University, which is called Europe's Productive Capital Gap, Mobilizing Pension and Household Savings to Scale Up Risk Capital. So what can we see from this study? First, we have very small, much smaller funded pension systems in Europe, and also lower allocation to risky assets. And risky assets in our study are defined as public equities, private equity, real estate, and infrastructure. So we are lagging behind in these areas, and so we are also challenging less of our savings into the real economy. So if we look at funded pension systems like we have in Australia, Canada, and Sweden, they have really a much bigger pool of risk capital, and also their workers. They have much higher allocation to risk capital than a worker in a pay-as-you-go country like Luxembourg, Germany, or France. If you look at the worker in Australia, Canada, and Sweden, we have calculated that they have 2 to 3 times more riskable capital per worker than in Europe, in other countries. And so this is around 209K versus 62 to 92K, which is a big gap. And also, the study shows that if this is a foregone opportunity for Europe as a whole, because if those assets or those savings were invested, with France and Germany alone, the foregone opportunity would be around 10 trillion. So it really shows that we have a gap, and so what could we do now to change this? And we have, in our study, looked at some markets which had positive changes, and it showed that those countries where workers have started, or individuals have started to invest early on, there was a compounding effect. So the pool of assets became bigger, therefore the allocation to risk capital became bigger, and so it is a virtuous circle. So I think we really have some way to go if you look at this gap.
Many thanks for these insights, Corinne. A little bit depressing, but I think there's way to go. So we can hear there are a lot of findings that came out of the study, which is a study, so a neutral view. But in your views, Corinne, what would be the key elements that would be required to make things change in a positive way? And who could help in this respect? Is it governments, industry bodies? Is it individuals, private initiatives? Or do we need to rethink entirely our approach, starting with schools, education of our kids, and so on? So what is your view?
Well, I think it's a combination of both. So first, let me say what Europe could do, and then let me go down to other parties. But I think the Commission has realized that they have a role to play. Obviously, we are all subject to European legislation, and as you know, the Commission and the pensions are outside of the scope of European rules and legislation. So what has the Commission done is they have said, okay, we see the big issue and gaps we have. What we can do is provide recommendations to the member states. So they cannot legislate in every context, but they can give recommendations, and they can monitor where member states are vis-à-vis these recommendations. So they are issuing some really big recommendations to the member states. First, please wake up and please collect data. And obviously they don't say it like this. So what they are saying, we are recommending that you should put in place for your citizens a pension tracking system. And so that citizens can see actually how much they are saving for their pensions. So first, let's recognize the problem for the citizens. Then let's recognize the problem for the member states themselves. So they have also issued a recommendation that member states should have pension dashboards. With these pension dashboards, we should be able to compare member states and also see how much they have in each pillar. Because for the moment, and I can tell it from the study, to get this data is not so easy. And third, they are going to monitor progress and ask member states to share their best practices. So there's each 6 months, each year there's a semester review each 6 months where the Commission is looking at how member states are doing on many topics, and pensions is going to be part of it, and they're going to focus on progress made. And then I think another thing they want is that we reach more scale. So how can we reach more scale? Well, they are recommending to member states, please give tax incentives or incentives in general so that people start to think and save for their pensions. Then they have looked at other countries which have been successful, like, for example, the UK. And what do they have is they have auto-enrollment. So if you're in the workplace, you are auto-enrolled in a scheme, and only if you say that you don't want to be part of the scheme, so you opt out, you are not saving. So this has brought massive monies into the schemes in the UK and also other countries. And then finally, they have issued recommendations, or they are going to look on another topic which is not in their mandate, which is financial education. So for citizens to be able to save, well, they need the tools, they need to have financial education. We can start, as you say, in schools. But in general, I think there needs to be much more done. And also the industry can help with that. So you say, what could associations do? Then there is one last point. And we were advocating we don't need new products. We have a large toolbox. But there were ideas, and they were coming from IOPA mainly, is shouldn't we not have a label, something which is catchy so that everyone is trusting in a product and says, I need to have that, I want this. I think it was not taken over by the Commission, but maybe something to think about, because I think if you have a catchy term or something everyone wants to have, maybe people will also want to have it for pensions.
That's a good idea, and I think catchy names always work really well. So a broad range of elements we would need to consider to effectively move the needle in Europe. But I guess likely many of our people in the audience today would agree these are the right things to do and very reasonable steps to take. So Corinne, may I ask where we currently stand? You spoke about a few ideas and proposals and recommendations, but can we only rely on recommendations, or do we have already ideas or products that could help us move into the right direction? What do we have, or do we need to start from scratch?
No, so the good news is we don't need to start from scratch. And we have also seen that certain countries are already successful in the EU, and I think Sweden is always held out as a good example. But so what do we have? We have a toolbox already. So we have two product frameworks in Europe, which allow even for cross-border products on pension world. And the one is for occupational pensions, the IROP, and the other one is for personal pensions product, the PEP. Unfortunately, both those two products have not been successful. For the IROP, the issue was that there were many barriers. So there were asset managers who tried to launch a cross-border IROP. They both, I know of two, both stopped the products. And the reason, therefore, is there were so many barriers and there were so many local requirements. Because, you know, it was not like for a usage product that you could get an authorization for the product and then a passport and just then, you know, start to distribute. No, there was always layers of additional rules. In each country you wanted to sell the product, you needed to comply with local labor laws, local social laws, etc. So that was unfortunately a very hard hurdle. So countries have now their local IROPs, but the issue with that is they are not reaching scale. The other thing we had is the PEP. We will come back later to that. But so in the IROP, there are some proposals from the Commission. First is that we should reduce these national barriers. So we should have, these products should also have greater investment flexibility. For example, in some countries, you could not just sell a life cycling product. There were requirements in the local country. You need now a capital guaranteed. So they're saying you should not, the proposal is not to include restrictions on the type of assets the IROPs can invest. So that is already giving asset managers more flexibility to, let's say, to structure products which they might then plug and play in the local markets. I think then they also are saying, and something again which should be good for asset managers, is that the member state should allow to require outsourcing, including investment management. And that is to reach scale. So asset pooling should be possible so that those funds can pool their assets, or those products could pool their assets, so that there are bigger chunks which could be managed by asset managers and build scale, reduce costs. It's also a matter of cost and scale. And so also they will want more transparency on the product. What we have seen also in our research is that a lot of those occupational pension products are not so transparent if you want to know what are the costs, all the cost layers, you know. So they are going to look into that. And I think the other thing is they say you could have multi-sponsor IRAPs, again, scale, and that you could also include personal pensions in the IRAP. So all of this is good news. And also they want to standardize the timelines for cross-border authorization. This was another big hurdle. It took for ages to get those products approved. So this is just a few good things they want to change. Maybe then the IRAP is going to be more successful. So Silke, I know that you have also worked a lot on the PAP, and the PAP was, let's say, in French, un mort-né, never took off. So what was the reasons and what can we do to make the PAP better?
So for PAP, as for IOPS, we have a new proposal, so a PAP 2.0 on the table right now, and are looking as ALFI and as other organizations very closely into what is changing. And we are very hopeful that PAP 2.0 will be a success. PAP is actually a great idea because it is a lifelong savings product that is portable. So European citizens can take it along if they move countries, if they switch from one employer to the other, or they have self-employed times. So it is a product that can fit with modern lives. So it could be a very nice product. What the PAP 2.0 proposal will change is that it will make it less complex in running. For instance, you spoke about the capital guarantee. There will no longer be a capital guarantee imposed. There will be a mandatory life cycle investment strategy for the basic PAP. And the basic PAP, which is really the mass product that should be available to every European citizen, that will be deemed suitable for all European citizens, which will make the selling of the product much easier. Also, it will become more attractive to PAP providers because there will be no longer a cost cap, which again is linked to what you said about the critical mass. If you don't have critical mass, you can never reach a cost cap as it was imposed in the first version of PAP. And finally, you spoke about risk capital. We opened towards that in the McGill study. Alternative assets shall now be allowed, and no longer will a PAP have to only invest into listed securities, so it will be opened up. So hopefully a very attractive 2.0 proposal. Corinne, what have I forgotten? There are other elements in the PAP proposal.
I think one important point, which again comes back to the element of scale and also portability, is that they will, at the moment, the proposal allows that employers could also contribute to the PAP, to the employees' PAP. So meaning that the PAP could be open to occupational pension savings. That would be amazing because that could be with auto-enrollment, as we discussed. So if you also introduce auto-enrollment, this could really scale up very quickly the PAP product. So we are quite excited about the still proposal version of the PAP 2.0.
Excellent. I think we have some work to do, but it looks promising. So thank you very much, Corinne, for these valuable insights in all the work you and the Luxembourg fund industry have been doing to support the development of a real environment in Europe towards a profitable, interesting, attractive pension environment. I'm very pleased to now hand over to our next panel. A&O Shearman partner Frank Mausen and his panel will look into securitization vehicles. Thank you very much.
Thank you, Silke. Good morning, ladies and gentlemen. Securitization is a critical pillar of the Savings and Investment Union, as Anne.George Kuzuhara rightly emphasized, because it acts as a powerful multiplier for financing. By enabling banks to repackage loans, such as mortgages or SME credits, into tradable securities, securitization frees up capital for new lending. This means more funding for households, businesses, and strategic EU priorities like the green and digital transition, as well as defense. It also helps diversify risks beyond the banking sector, making our financial system more resilient. The importance of securitization has been recognized recently by the Letta, Noyer, and Draghi reports. Yet, the securitization market has been underperforming for years, largely due to overly conservative rules introduced after the 2008 crisis. That's why the EU authorities are now revisiting the securitization regulation. The goal? Simplify due diligence, adjust transparency requirements, and make capital treatment more risk-sensitive while maintaining strong safeguards. Where do we stand today? The Commission published its proposals of the reforms in June 25. The Council reached a political agreement in December 2025, and we are now waiting for the European Parliament to finalize its position that is to be voted on in May. After this European Parliament position, we will enter into so-called trilogue negotiations between the Council, the Commission, and the European Parliament. And it is expected that the text will be finalized by the end of 2026 or beginning of 2027. This is a live debate, and its outcome will determine whether securitization can truly deliver on the SIU's promise to mobilize private capital for Europe's future. With that background, let me introduce our distinguished panelists. First, we have Paula Redondo Pereira, Head of Government Relations and Regulatory Strategy at the Luxembourg Stock Exchange. We have Dr. Michael Genser, Head of Solvency Management from Deutsche Bank in Frankfurt. And my name is Frank Mausen. I'm a Capital Markets Partner at Shearman Sterling and Chairman of the Luxembourg Capital Markets Association. Now, let's dive into how securitization can help bridge Europe's financing gaps. Despite its post-crisis stigma, securitization is now seen as a cornerstone of the SIU. The EU has traditionally been very bank-centric. Roughly 70% of corporate financing comes from banks, with only 30% comes from capital markets. Compare that to the US, where the split is almost reverse. About 80% is market-based financing and only 20% bank lending. So the question arises, is this recognition of the importance of securitization a signal towards deeper capital markets in Europe and a move away from our traditional reliance on banks? Paula, is this wishful thinking from a capital markets lawyer, or is it becoming a reality?
Thank you, Frank. Well, I don't think this is wishful thinking anymore. It actually reflects a real change in mindset. Europe has traditionally relied, as you mentioned, very heavily on banks. But today, there is growing recognition that capital markets must play a stronger role alongside banks, not instead of them. Securitization fits very well into this evolution. It allows existing credit, being mortgages, SMEs, loans, project finance, to be transformed into investable assets. That is how savings can flow more efficiently into the real economy. From the exchange perspective, we see increasing interest from issuers who would not have considered capital markets 10 or 15 years ago. That shift requires literacy, trust, confidence. But I believe that it is clearly happening. So yes, this shift doesn't happen overnight. It is gradual. But in my perspective, it is becoming reality.
So just let me add one thing from a capital manager's perspective. While I agree with Paula that there is a wide agreement that capital markets need to be strengthened in Europe, it's nothing that can be just achieved top-down. So what I think is the difference between the US and the European capital markets is huge, as you've said, Frank, in the beginning. Now, the confidence of US corporates in capital markets has been established over decades. I mean, Europe doesn't have that tradition. So in Europe here, our clients still prefer to come to us, negotiate with a bank, on a credit and then a loan. And this personal relationship is something that apparently European corporates value. So that means one needs something in between this bank relationship and then, say, getting to investors, which means there must be an intermediary. And I think, as Paula, you have mentioned, the securitizations can be one tool that has this ability to bridge the gap. Now, we do see also strong demand from investors for corporate credit. So banks and all other financial intermediaries along sort of this investment product value chain should now really put their efforts together to then come to what we might call an institutional version of the capital markets union and the saving and investment union. So, yeah, I hope that we move into exactly the direction that Paula has mentioned.
That's very encouraging news for capital markets lawyers. Thank you for this, Paula and Michael. So under the SIU, securitization is positioned as a key enabler. But is it truly a funding tool for the real economy or simply a capital management instrument for banks? So Michael, in your role as banker, what do you think?
Actually, securitizations are fascinating because they can serve a lot of purposes. And I think they can exactly, as you say, bridge the my capital management objectives with funding the real economy. But let me try to explain that a little further. So it is this triangle between an investor, the bank, and then our corporate clients. And from a bank's perspective, so when we try to serve our clients, then there could be, for example, a limit on the exposure that we want to take. So securitizations could be one element to pass on risks to the market, to an interested investor, but still us being there to serve the client directly, as sort of traditionally the banking sector has worked. And this is another angle. So if you go look at it from a group perspective, so we might be in our target operating range and then have only limited capacity to expand our loan book. But here again, securitizations can, from just the group perspective, free up capital that allows us to then originate more loans where the risk we simply pass on to investors. And look, as I said before, investors are interested, and there is the opportunity for a lot of investors to invest in securitizations because through the tranching mechanism, you have different risk types or different risk aversion levels that you can accommodate there. So, as you see, there is a mutual interest in investors and us to come together. And this is why I think securitizations do have a strong, or is one of the products that can really make that happen, what we discussed at the beginning. So funding flow to real economy through that tool and thereby sharing the risk wider in the economy.
Securitization was long blamed, often unfairly, for the last financial crisis, prompting strict rules to restore trust. Yet the current framework has not reignited the market. With new reforms now on the table, will they finally turbocharge securitization and rebuild confidence? Or is more needed to make the capital markets thrive in Europe? Paula, what's your take?
The reforms are clearly a step in the right direction, but I would not say they are sufficient on their own to fully revive the European securitization market, or as you frame it, to turbocharge the market. What do I mean? Let me break it down. We need ambition on capital treatment and investor demand. The current proposals focus mainly on definition, disclosures, and due diligence. These elements matter, of course, because they are likely to reduce friction and legal uncertainty. But the real test is whether the framework truly makes securitization more attractive, both for issuers and for investors, as Michael suggested. So if rules are perceived as too complex, too restrictive, or disconnected from economic reality, activity will either stay limited or move to other jurisdictions. So I agree with Michael. Capital treatment remains a key issue. Banks and insurances need risk calibration that reflects real credit performance, not post-crisis conservatism. If regulatory capital treatments are not properly aligned with the actual risk of securitization exposures, especially for high-quality structures, the market will struggle to scale. So, all in all, confidence will return not just through transparency, but through a framework that is proportionate, predictable, and internationally competitive. This is key. So the balance between safeguards and usability is, in my perspective, what will determine whether securitization can truly deliver for the savings and investments union.
Thank you, Paula. I couldn't agree more with you. So the current proposals to amend the securitization regulation primarily focus on definitions, due diligence, and reporting. In my personal view, these changes fail to address the real obstacle, to create a dynamic securitization market. The risk rating for banks, particularly the well-known flaws on tranche risk rates and the famous P factor, remains excessively punitive. Likewise, Solvency II capital charges for insurers investing in securitization positions do not accurately reflect underlying risk and require a substantial overhaul. Michael, do you agree with me?
Frank, I do. So, and I think you made a very good point. I want just to continue what, Paula, you have started with explaining. So, when I go back to my statement before, there was one element missing, that's the price. I mean, we need to agree on the price with an investor if you want to sell risks. So, and that could be very hard in the current environment. So, you mentioned two highly regulated industries, which is important. On the investor side, the insurer, us selling the assets potentially, and then us two need to sit together. So if you think of a bank offering assets, of course it's the portfolio loss that determines a large part of the price, but also it is we want to free up capital with that to extend new loans. And by the same time, then we price that into the transaction. So similarly, an insurance company, if they invest, they need to hold capital for that. If this is too punitive, they require a higher price. And in that way, if these risk profiles are not aligned across these two important regulations, well, you will not simply find a market for it. And I mean, you can take it maybe on one element, an example that I had, so that whenever we tried to sell, for example, a low-risk mortgage book, it was extremely difficult to find the price. Why? Because the securitization framework is so conservative that our, say, capital relief was so small that the price we could offer is too low for an securitization, so an insurer actually to invest in that instrument. So if we now think of, say, the two frameworks, the CR3 and the Solvency rule set, they still have these conservative features. And I agree with Paula that the now discussed proposals that we have on the table, they are that want to remove some of these overly conservative rules is, in my view, a step into the right direction, but it needs to be decisive so that it opens up the markets for those low-risk books, which we do have on the bank balance sheet quite a lot, and which are attractive also for investors. So that means the markets will only open up if, yes, these elements are aligned, and in the end, yes, we find the price.
So I think, Paula and Michael, we all agree that securitization has the potential to play a pivotal role in implementing the SIU. And as Luxembourgers, we believe that Luxembourg can play an important role in that SIU initiative. So Paula, what does the Luxembourg ecosystem bring to the table?
Well, I would say that Luxembourg does bring a very strong and proven securitization ecosystem to the SIU. Over the past 2 decades, Luxembourg has built a legal and regulatory framework that is widely recognized for its pragmatism, legal certainty, and efficiency. This is reflected in the numbers. Luxembourg hosts more than 1,500 active securitization vehicles and represents roughly 30% of euro area securitization vehicles. That is not by chance. It shows long-term market confidence in the jurisdiction. Luxembourg also combines this with a very deep investor base. The fund industry represents more than 6 trillion euros in assets under management, which is, of course, a major advantage when it comes to attracting institutional investors to structured products. And importantly, Luxembourg offers an ideal framework to structure all types of securitization, from public high yields, quality STS securitization with Luxembourg SPVs to a wide range of private securitization using all types of underlying. So from the Luxembourg Stock Exchange perspective, it goes without saying that exchanges play a complementary role, providing transparency, visibility, and access to international investors. I can share, we list a large share of global debt securities, including, of course, structured and sustainable instruments. We are leading listing venue for STS transactions with originators from various European countries, choosing our regulated market for their public deals, but also our MTF, our exchange-regulated market, offers a dedicated framework for private securitizations targeted to a limited number of professional investors. Last but not least, Frank, allow me please to highlight the green dimension of the discussion, which is very important for us. Bear in mind our sustainable finance footprint. Green securitization, for example, backed by energy-efficient mortgages, renewable infrastructure, or transition assets, could become a powerful channel to mobilize private capital for green and climate transition. But this will only work if securitization rules and sustainable finance rules overall are coherent, credible, and easy to apply in practice. So, taken together, Frank, to your question, this makes Luxembourg not just a domicile, but a full platform and ecosystem supporting the Savings and Investments Union objectives.
Thank you, Paula. I think the Ministry of Finance likes to hear that. So over the past couple of years, Luxembourg has established a highly modern securitization framework. And many of my clients call this the gold standard, thanks to its ability to reduce time to market and enable efficient issuances of capital market products. So from Deutsche Bank's perspective, how do you view Luxembourg's role as a hub for capital market issuers?
So, Frank, I can't only echo what Paula has said and what you have already indicated. So Luxembourg is for us a very important strategic location. We are here since 1970, and we've continued to expand the location. What was formerly, say, a small entity which started in trading foreign exchange equities and other securities. Nowadays, we've got all of our divisions here, and it's in particular what Paula, you have mentioned, this come together of, first of all, the expertise of structuring the legal framework. Say it's a lovely country, political stable, AAA rated. It has all these center of competences just here, and that makes exactly the difference then to other locations that we have seen. So insofar, it is for us, say, we've got wealth management clients that we serve here, corporate bank clients that we serve here, and investment banking clients that we serve here. So all what is cross-border financing is something which is very attractive to do here in Luxembourg. And then, of course, with DWS Group, Paula, you mentioned it, fund industry is something that is very strong here. And of course, we are also then here with our DWS franchise.
That's good to hear for Luxembourgers. So, conscious of timing, so one quick last question with the request for a very short answer, please. If there's only one point you believe the authorities should prioritize to make SIU a success, what would it be? Perhaps let's start with you, Paula.
If I had to choose one priority, it would be trust. Trust across the entire ecosystem. First, trust from investors that the rules are stable, proportionate, and enforceable. Second, trust from issuers that coming to market in Europe is worthwhile and competitive. And third, trust from policymakers that capital markets can support growth without undermining stability. To build that trust, we need regulatory predictability and a long-term vision that goes beyond single legislative fixes. And I'm a lawyer, okay? So if the SIU creates that confidence, securitization can truly play its role as bridge between European savings and long-term investments.
Michael, what's on your wish list?
Well, more or less continuing what Paula has said. So if we go one step back and understand that regulation is, of course, necessary for the financial industry, but really taking one step back, seeing what the purpose of regulation is, and now removing those impediments that we've discussed today, and let the market find, again, a good solution, that is what I would like to see. So if I had a wish free, I would say do regulation that is appropriate for the risks that are in the pools, that are in the securitization structures. And then I would guess markets would open up and we come together and have a lot more potential than we do it today.
Thank you, Paula and Michael, for sharing your insights and perspectives. I think today's discussion made one thing clear. Securitization is not just a technical instrument. It's a strategic enabler for Europe's SIU. If we want to close the financing gaps for the transitions, green or digital, the defense, strengthen competitiveness and build resilience, we need a securitization market that works. The reforms that are currently on the table are certainly a step in the right direction. But as we heard, more ambition is needed, particularly on capital treatment and investor confidence. Luxembourg, with its very robust legal framework and its international ecosystem, is well positioned to play a leading role in this transformation. Ultimately, success will depend on collaboration between policymakers, market participants, and investors to strike the right balance between prudence and growth. If we get this right, securitization can truly deliver on its promise, mobilizing private capital for Europe's future. Thank you all for joining us, and let's keep this conversation going beyond today. And now over to Jérôme Wigny, who will moderate the panel on private capital for Europe's strategic industries.
Thank you, Frank. I have the pleasure now of welcoming Mathieu Jourde. Mathieu has been an equity portfolio manager with BNP Paribas Asset Management for about 5 years. And as you will see, he is well versed in the following topic. Europe is focusing on certain strategic industries because of recent crises, which have evidenced the risk of being over-dependent on external suppliers. At the same time, investing in these strategic industries ensures long-term competitiveness. Mathieu, good morning.
Good morning.
My first question to you, thank you. My first question to you is about defense. As we know, this seems to be one of Europe's main current topics. Could you give an overview of the latest announcements made by NATO and by the EU?
Yeah, of course. Thank you for the question. If we start with NATO, the key point is the scale and the time horizon. In June 2025, NATO summit in The Hague allies committed to a 3.5% of GDP core defense spending, plus 1.5% on defense and security-related spending, with an ambition up until 2035. On the EU side, there is also a shift about industrial capacity and readiness. The flagship framing is the Rearm Europe or Readiness 2030 also envelope, which is around 800 billion euros. If we talk about more specifics, for example, about NATO requirements, we can think about member nations that must hold supplies up until 30 days of high-intensity warfare stocks for ammunition, which implies tens of millions of artillery rounds to be produced. And we have to take into account that it's currently only 1.5 days of stock of ammunition currently for European countries. So it will take years to be able to attain this target of 30 days. Why was it decided this 30 days target? It was at the time for European to resist an invasion and in order to wait for the US Army to come and help. It seems, however, that there is some issues about the reliability of the US umbrella, which is debated more openly. So there are even further discussion to stock even more than the 30 days initially thought about. But we can estimate growth for the defense sector industry in Europe to be quite significant. For example, if we estimate an increase of defense spending about 8% per year for Europe, out of which 13% of growth would be targeted more specifically on investment. And within this investment, there would be the target would be around 65% to be spent for European companies. To be more realistic, but still optimistic, it should be around 50% around 2030. If we take all these figures together, brokers are estimating that the growth for the addressable market for companies should be around 20 to 30% per year up until 2030, which is very significant and in quite a significant investment opportunities for investors. But it explains also why the sector has re-rated quite significantly since a few years. We're around 29% PE for 2026 results, but we're still below the valuation ratio, for example, for the MSCI World Aerospace and Defense, which is around 32. Which means that there might be still some room for the stock to go higher.
So very impressive growth expectations for defense. What about the other strategic industries and their growth expectations?
Thank you. I would say that several sectors are indeed expected to grow significantly in the coming years. It's been highlighted indeed by Draghi's report, which has a diagnostic for Europe, which is Europe has a growth and productivity gap versus the US, and a lot of dependencies which have become vulnerabilities. So the aim of following Draghi's report would be to close the innovation gap, to lower the energy handicap, and to rebuild security and reduce strategic dependencies. So if we take the innovation gap, we can think about, for example, the semiconductors and advanced tech, where there is the European Chip Act, which is mobilizing more than 43 billion euro in a public-private commitment up until 2030. According to some brokers, we have an estimation of growth for 2026 for this sector around 15%. We have also, in terms of sector impacted, the energy system and infrastructure, where we have major capex program, for example, like Germany 500 billion infrastructure fund, and EU programs such as Repower EU. Here, the reliability is a key topic. Grid is key. Energy storage also. We can think about hydroelectricity, battery oils. And we can think also about a backup source of energy, such as gas, which is currently a bit the king in the market. We can think about some specific stocks such as Siemens Energy, which had a tremendous stock rising recently. It's also helped by a data center demand, which is increasing the need significantly. If we think about end market here, brokers also are thinking about a growth about 23% about data center and around 10% for grid. To give you also some perspective in terms of what we can expect on the energy sector, more specifically on gas price in Europe. Short term, we're around 12 USD MBTU in Europe versus 3 to 7% USD for the price in the US, depending on the, I would say, the weather currently. But there is a structural difference which will be here between US and Europe, around 4.5 USD per MBTU, which is caused by the cost of energy compressing, transport, and then decompressing with hoping a 10% return on target. So which means that we're going to have for a medium term, at least the gas price is going to be twice the price in Europe than the one in the USA. To give you also some information on the price concerning renewables, the latest offshore wind farm auction in the UK had a guarantee price of 91 GBP per megawatt, which is quite similar indeed to a nuclear plant and gas, but not including grid, backup or storage. So which means also that some alternative energy are back into conversation. We can think, for example, about nuclear. And lastly, about critical material and industrial resilience. We see that supply chain are geopolitically concentrated. Indeed, there are around 90% of rare earth minerals which are processed in China. And the Critical Raw Material Act aims to change it for Europe and aims to shorten the timeline for supplying rare earth minerals, for example, for Europe. It takes around 8 years currently to open a mine. So indeed, it's a long time.
So governments are expected to invest massively in those industries, and that builds the case for private markets to tag along. Do you have a feeling for the amounts that one expects to raise and to see being invested in those industries coming from private markets?
I would like to have an exact figures to tell you. Unfortunately, I don't have it. What I can tell you is that I would say private capital follow bankable frameworks. So in order for private capital to invest, they need to have some visibility about the revenues and long order visibility. So it's easier for private capital to invest in some sectors. For example, ramp up is easier for admonition than for complex platforms. We can see that private capital was quite successful for a CSG IPO recently, which means that private capital is indeed here, but it needs to be with some visibility on the production. There are, however, some energy transition business models still struggling to be profitable with current technology. We can think about CO2 carbon capture, which is around 400 euro per ton versus around the price of 90 euros for the market. So still not profitable. And synthetic fuel, which is hydrogen plus CO2, which is currently 5 times more costly than conventional oil price. So which means that private market will have some struggle to invest in it without being subsidized.
And what is the perception of all this, depending on the type of investors, between the long-term investors, pension funds, for example, and the more retail family office type investors?
I would say that globally, the investor perception is constructive on the direction, but selective on timing. We tend to see a very high volatility concerning any ceasefire headlines. We could see very easily a 10% corrections on the hope that of a Ukraine ceasefire. but it seems that they re-enter the market when order book and earning visibility indeed are confirmed and remains intact. I would say that concerning institutional, that we can see also two types of investors: the hedge funds, which are very short-term and volatile, and then long only, which are indeed long-term. I would say more globally, less sophisticated investors tend to buy the theme as a headline basket, while more sophisticated investors tend to treat it as more a stock picking and sequencing story, depending on the ramp up, for example, in publication.
And if we come back to defense, do you see a number of investors reluctant to invest in that asset class, either because of internal guidelines or because of ESG?
Yes, some investors remain reluctant, but there's three kinds of topics: regulations, label, and house policies. At the EU framework level, many constraints are focused on controversial weapons and norms. So it's not a blanket ban on defense, for example, but there is some more scrutiny on landmines, cluster munitions, chemical and biological weapons, and so on. We, however, still have some strong constraints from some ESG label, such as the Belgium feeble film towards sustainability label, which has still constraint on the defense sector, but there are discussion about this matter currently, so we can hope that the label is going to be less constrained in the coming years. I also know personally some institutional investors thinking about relaxing ESG constraints on nuclear and defense, especially on bond selection.
And maybe to close, a general question on the Savings and Investments Directive or Savings Union. Do you feel that this is fruitful? Do you think it's going to be successful? Or at the end of the day, is it for private capital mainly a question of whether there is a business case in investing in those industries?
For private capital, it's always the same. It's there need to be a business case first before investing. But I mean, it's a step into the right direction. It's the Saving and Investment Union is a plumbing side of the competitiveness agenda. On timeline, unfortunately, with Europe, we have to learn to be patient. It's, as usual, measured in years, not in quarters. As a reminder, the Draghi's report is from late 2024. The Saving and Investment Union strategy was adopted in March 2025. Consultations are currently occurring. And concerning the, I would say, the pension package, which is another package of the Saving and Investment Union, it's a package that really shapes long-term investment behavior and institutional demand. It should take longer. So according to internal sources, maybe a realistic implementation horizon should be around 2028, 2029. I mean, for long, we have to be patient here, but it's a step in the right direction.
Thank you very much, Mathieu. It was very insightful. And back to you now, Benoit. Thank you.
Thank you, Jérôme. Ladies and gentlemen, as we come to the end of today's discussion, a few clear messages stand out. First, Europe's challenge is not a lack of savings. The real issue is how well those savings are channeled into productive long-term investment through pensions, capital markets, and the financing of our strategic industries. Second, the Saving and Investment Union is not an abstract policy exercise. It is about making Europe's financial system work better for the real economy by strengthening the link between savers, investors, and companies, and also by allowing capital to flow more efficiently across borders. Third, delivery will be key. Whether we look at pensions, securitizations, or private capital, success will depend on practical implementation, regulatory clarity, and the ability to build trust and scale over time. From a Luxembourg perspective, today's discussion also illustrates the importance of openness, cross-border finance, and stable frameworks. These are not abstract principles, but real concrete conditions for mobilizing capital in a competitive and interconnected global environment. Ultimately, the Savings and Investment Union will be judged not by the ambitions of its strategy, but by its ability to deliver long-term investment at scale in support of Europe's competitiveness, resilience, and strategic autonomy. This morning's discussions have shown both the complexity of the task and the depth of expertise available to address it. And for all of that, I would like to thank you, all our speakers and moderators, for their valuable contribution, as well as our sponsor, Shearman. And I also would like to thank you, all of you, for watching this live stream. I wish you a pleasant rest of the day.